Good morning and welcome to Local Business Focus. I'm Sally Barker. Joining us this morning is Michael Deegan from Do Financial, proud station sponsor. Good morning, Michael.
Good morning, Sally.
Now, today we're talking about lending through self-managed superannuation funds. Now, we do talk a lot about self-managed super funds, but the term lending through them doesn't often come up in conversation. Can you tell us what that means?
Sure. So it is a strategy that is growing some momentum. We probably want to make sure that people really understand the principles behind it, and also that they're getting the right advice from their financial planner and accountant as well. That's crucial that they involve those professionals. Lending through self-managed super fund, there's a term, limited recourse borrowing arrangement. So people might see this sort of LRBA mentioned. That's what that refers to. There's also some pretty important industry supervision that applies to self-managed super funds, and that's called the SIS Act. So that applies to the regulation for superannuation funds. So we're just sort of mindful that people may read a little bit about this strategy, but they definitely need to know a bit more about it before they go into it.
Well, I think we should understand what a self-managed super fund is. Can you just give us an overview of what that is?
Certainly. So in accordance with advice from financial planner and accountant, an individual might choose to set up their own self-managed super fund instead of having their superannuation invested in an industry fund.
Okay. To do this, can an individual do that themselves? Do they need to go to an accredited provider who can set that up for them?
They do need to have that established through a financial planner and an accountant.
But not just any accountant or financial planner. We have to have a special license to do that. Is that correct? Or
correct? Yeah. So the financial planner would. Most financial planners are regulated to provide advice on self-managed super funds. Accountants, look, the laws have changed in July last year, so an accountant would need to have specific licensing requirements to be able to give that advice.
So ask first.
That's right.
Yeah. So how do we go about lending through our SMSF?
Okay, so there's a few key structures that need to be established first. There needs to be corporate trustees established for both the self-managed super fund and also then what is called the Bear Trust. So essentially, the strategy involves the self-managed super fund purchasing an investment property, either residential or commercial. The lender will provide funds to the super fund, but the actual legal entity that owns the property whilst there's a debt is called a Bear Trust. The self-managed super fund will make payments to the lender. The tenant in the property will pay rent to the super fund, and the super fund will then continue those repayments. When the debt has actually been finished and it's no longer in place, then the property can be transferred back to the super fund.
So when you say transferred back to the super fund, how do you transfer a property back to the super fund?
Sure. So that again comes down to having the right advice and the right structure set up in the first place. So the documentation when the property is purchased will show that the property is being held under beneficial ownership for the self-managed super fund. That's really crucially important because we don't want people to be in a situation where there's a double stamp duty effect when that property is transferred to the super fund.
Okay, so that's why it's important to get the right advice from the start when you're setting this up.
That's right.
Okay, so why would you do this?
Yeah, so look, again, it comes down to the individual strategy for that person. If a self-managed super fund is right for them, it does provide the opportunity to purchase direct property in a location where it's suitable for the customer and a property that they might like to purchase. Another great opportunity that presents itself is actually for business owners. So those that have a trading business may choose to buy a commercial property through their self-managed super fund and then effectively lease it back from their super fund. Now that needs to be done through a corporate lease agreement, and again solicitors need to be involved to have that drawn up. But effectively, it provides the opportunity for the business owner to be paying rent to an entity which ultimately is going to benefit themselves.
So it sounds like a pretty smart strategy. What percentage do you need to have in your self-managed super fund before you can start employing one of these strategies?
Sure. Look, lenders do have various policies, and they do range quite significantly. So the really important thing is if you are thinking of the strategy, then have a really careful discussion with your financial planner, accountant, and broker, because they'll then do the investigation for you to find out how much you need to have in your super fund.
Okay. If you're going down this road, are you personally protected if things go wrong?
Okay, so that's a great question, Sally, because the term limited recourse borrowing means that whilst there's debt on the property, the other assets in the self-managed super fund are protected. However, the bank will also require that the members of the super fund, which will also be the directors of the corporate trustee, they will need to provide personal guarantees. So in that situation, they are personally liable for the debt. So they definitely need to seek advice from a solicitor to understand their obligations around that.
Wonderful. Thank you so much for joining us this morning on Local Business Focus. Michael Deegan from Do Financial, proud station sponsor.
Thanks, Sally.